Imagine a company sitting on $6.27 billion in net cash, growing its earnings at a pace analysts expect to hit 32% a year, and yet its stock has moved less than 3% in the past 12 months. That's Shopify right now, and once you see the numbers behind that gap, you'll understand why so many investors are confused about what this stock actually is. Let's start with the size of this business. Shopify currently carries a market cap of $160.75 billion. That's the total value the market has placed on the company. Its enterprise value, which factors in cash and debt to show what it would actually cost to buy the whole business outright, sits a bit lower at $154.48 billion. Already, that tells us something interesting. Shopify has more cash cushioning its valuation than debt weighing it down. Now, here's where it gets more interesting. In the last 12 months, Shopify generated $12.37 billion in revenue and turned that into $1.33 billion in net profit. That's a profit margin of 10.77%, meaning for every dollar of sales, about 11 cents becomes actual profit. Not bad. But here's the part that trips a lot of people up. Shopify's trailing price to earnings ratio, or PE ratio, the number that measures how expensive a stock is relative to its actual profits, is sitting at 121.72. To put that in plain English, investors are currently paying about $122 for every $1 of Shopify's current annual profit. At first glance, that sounds incredibly expensive, but here's where things get interesting. Look at the forward PE ratio, which estimates the same thing but based on expected future earnings instead of past earnings. That number drops all the way down to 64.89. That's nearly half. Why does that matter? Because it signals the market expects Shopify's profits to grow significantly. And that lines up with another number buried in the data. Analysts are forecasting revenue growth of 25.87% over the next 3 years, and earnings per share growth of 32.1% over that same stretch. So the sky-high PE ratio isn't necessarily a red flag. It might just be the market pricing in a very different Shopify a few years from now. But before you get too excited about that growth story, here's a number that should make you pause. Despite all this projected growth, Shopify's stock price has only risen 2.97% over the past 52 weeks. That's barely any movement at all for a company analysts are this optimistic about. And that mismatch, big expectations, small price movement is exactly the kind of contradiction that makes this stock so debated. Now let's talk about financial strength, because this is where Shopify starts to look genuinely impressive. The company holds $5.74 billion in cash and cash equivalents, but only $179 million in total debt. That gives it a net cash position of $6.27 billion, or $4.82 in cash alone for every share outstanding. Its debt-to-equity ratio is just 0.01, which is about as close to debt-free as a large company gets. And its current ratio, a measure of whether a company can cover its short-term bills with its short-term assets, is 6.20. Anything above 1 is generally considered healthy. Shopify is sitting at 6 times that. This financial cushion shows up in 2 other numbers that don't get talked about enough. Shopify's Altman Z-score, a formula used to estimate bankruptcy risk, is 65.83. For context, a score above roughly 3 is typically considered a safe zone. Shopify is more than 20 times above that threshold, and its Piotrowski F-score, a 9-point scale that grades overall financial health, sits at 6, a respectable middle to upper score, so the company looks financially rock solid. But here's where investors often get confused, because a strong balance sheet doesn't always mean a cheap stock. Look at return on invested capital, or ROIC, which measures how efficiently a company turns the money it has into profit. Shopify's ROIC is 23.25%, a strong number. But compare that to its weighted average cost of capital, or WACC, which represents what it costs the company to fund its operations through debt and equity. That number sits at 18.45%. The gap between those two numbers is where real value creation happens, and Shopify's gap is positive but not massive. And that's not even the most surprising part. Shopify's beta, a measure of how volatile a stock is compared to the overall market, is 2.58, A beta above 1 means more volatility than the market average, so this stock tends to swing significantly harder in both directions than a typical stock would. That helps explain why, even with strong fundamentals, the stock hasn't moved in a straight line. One more piece worth mentioning before we wrap up. Short interest, the percentage of shares that investors have bet against, sits at just 1.64% of shares outstanding. That's a relatively low number, suggesting there isn't heavy pessimism from short sellers weighing on the stock right now. So where does that leave us? On one hand, Shopify has an almost debt-free balance sheet, a massive net cash position, strong liquidity, and analysts projecting real growth in both revenue and earnings ahead. On the other hand, the stock trades at a very high earnings multiple. Its price has barely moved over the past year despite that growth story, and its volatility means it can swing hard in either direction. Strong business, expensive price tag, big expectations, quiet stock performance. Given all of that, the real question is this: is the market simply being patient with Shopify while it waits for that projected growth to show up in the numbers, or is it hesitating because that growth still has to prove itself first?